Listen to your favorite shows live and on demand 24/7. Download the 77 WABC mobile app now. It's the Larry Kudlow Show. Free market prosperity starts here. Now, here's Larry Kudlow.
Welcome back, everybody. I'm Larry Kudlow. Great pleasure to be with you. Bond rates fell. Stocks don't like recession. String of bad numbers. Recessions kill profits. That's my first take, and we will hear what our players are saying. Ladies' night out. Nancy Tengler, CEO and Chief Investment Officer of Laffer Tengler Investments. Her latest book is The Women's Guide to Successful Investing. And Stephanie Pomboy, founder and CEO of Macro Mavens, LLC. Ladies, thank you for this. Stephanie Pomboy, I'm calling it the front end of a recession. Stocks don't like recessions. Recessions kill profits. Profits are the mother's milk of stocks. So that's my point. Take it from there.
No, I couldn't agree with you more, Larry. First, thanks for having me back. I have been sort of forecasting this recession for a long, long time and been wondering why it's taken so long to materialize. And since I watch your program religiously, I have to nod in rigorous agreement with what Scott Bessent said to you yesterday about how the average American has been in recession. And for a while, in fact, there was a survey done recently that said 3 in 5 Americans think they're in recession now, and that it actually started in March of last year. So it's been masked by this high end that's been doing so well, and that's kind of sustained this exuberance in the markets, as have the high-end corporations. You know, the skew we have in the consumer sector is mirrored in the corporate sector, and I don't think people fully appreciate how much of an impact the high-end corporations play, not just in driving the price movement in stocks, but also profits. You know, if you look at profit growth, it's all concentrated in the top, 10% of companies, and the rest of the universe is not doing so well. So I think the recession has been in train for a while, and yesterday's payroll report just kind of put it front and center. And then, of course, the markets panicked because they suddenly woke up and said, wait, if we're actually going to go into recession and the Fed isn't even cutting rates yet, maybe they'll be behind the curve. To which I say, duh, the Fed is always behind the curve. They've never gotten it right. So,
by the way, just
my riff on it.
Scott Bessent's a pretty smart guy. We've become quite friendly. You see a Treasury Secretary there, Stephanie?
Oh, I would be enthusiastically supportive of that.
Yeah, he's a very bright guy, and he's got his head is screwed on right. And Nancy Tengler, he gets the model. He understands the supply-side model very, very well. For a hedge fund guy, particularly, because that crowd is usually so liberal and left, at least in recent decades. It wasn't when I was working on the street, but it's all changed. I don't understand it. I don't even understand any of this stuff. But
Well, Larry, if I could just add, especially coming from where he got started in the hedge fund industry.
Where did he start?
George Soros.
Oh, of course. Well, so did Druckenmiller,
Yes.
I mean, he's fabulous, but, let's not talk about Soros. It's way too weird. Nancy Tengler, what are you doing here? How do you play this front end of a recession, profits? I think Stephanie's on the right track. What happens here, Nancy?
Well, thanks for having me. Great to be on with Stephanie and you. I think that you have to listen to the companies, Larry, and that goes to what you always say about earnings being mother's milk of stocks. There are bright spots in the economy, and Stephanie pointed out some of them, which are the large cap tech names that have, in many cases, hundreds of billions of dollars on their balance sheets in cash, and they're benefiting from higher interest rates, and they're generating pretty enviable earnings. Now, the valuations, we could have that argument, but I think that's where you want to hide out. And then on the consumer side, what we've seen is, of course, the consumer staples names have really gotten hit because they have no more pricing power. Again, to Stephanie's point that the consumer has been in a recession. But then you have names like Spotify that just continue to delight. And so it really matters what you own in this environment. And I'll just say, I've been listening to the show today, as I always do, and Pat Gelsinger at Intel has been a colossal disappointment. Going hat in hand to Washington.
That's all he does. That's all he does.
Yeah.
Whining.
Yeah.
He was come up to my office and whine.
Yeah, and meanwhile, the company wasn't being managed. We got out a while ago. Now, we're not always right for sure, because I think I told you I live in a perpetual state of dissatisfaction because I buy something, it goes up, I didn't buy enough, but it goes down, I bought way too much. But that one we got, and that's what it's important for your listeners. Managements matter. You can't live on your brand forever. So we're really sort of jumping lightly, and treading lightly, looking for opportunities with great management teams that will weather the storm. Defensive names like Apple, for example, Microsoft. You can still make money in this environment. It's just going to be harder.
Well, I will say this. The cyclicals, the economic sensitives got clobbered. Industrials down 2.8%. Bank, financials 3%, energy 3.7%. Energy prices really coming down. Tech minus 4% for the week. Consumer discretionary, as you were suggesting, minus 4.3%. One thing that really blows my mind, the small cap Russell 2000 down 6.7%. In some sense, that's the ultimate economics. The smaller, they're public companies, but they're smaller public companies, which probably means small business in a heap of trouble, which is kind of what we've been seeing on these small business surveys. So I don't know. It's kind of rough sledding. Stephanie, what does an investor do here? Oh, let me add one more thing before you take off. Huge decline in bond rates, government bond treasuries. The 2-year note down 51 bips, the 5-year down 45 bips, the 10-year down 40 bips. The 10-year closed the week at 380. Now that brings relief in some sectors and some borrowing costs, perhaps. But also, when interest rates fall a lot, that's usually a recession signal. Rates go up in recoveries, go down in recession. So there's that, Stephanie.
Yeah, absolutely. And I would point out that credit spreads widened out last week. I mean, we've lived in this world where you've had this largest wave of corporate bankruptcy filings since COVID and the Great Recession before it, and yet credit spreads continued to narrow. So I think the markets had this confidence that, hey, the Fed was going to pivot, so this world of higher rates was just a temporary phenomenon, and before you knew it, we'd be back to the happy land of 0%, free money for everyone forever. And so spreads continued to narrow. But that was the big story, in my view, last week, was that as the Treasury complex rallied hard, nominal yields in both investment grade and high yield moved higher. So the spreads blew out to the upside, and that's in keeping with what you would expect if we're going into recession. Another signal that I love to look at, which relies – I don't have a PhD, so I outsource my PhD to Dr. Copper. Copper is down 20% in just 2 months. I mean, if that isn't a recession signal, I don't know what is. But what's really interesting and a signal I love to watch is the gold-copper ratio, which has been a reliable sort of canary in the financial crisis coal mine, because when copper is going down, it suggests economic weakness, and when gold's going up, it suggests financial stress. So the ratio of the two tends to be, a pretty strong signal of cracks forming, and that ratio just blew out to its highest level since the COVID recession. They're warning.
Gold up 2%. Gold up, closed the week at 24.37, back over 2,400. By the way, your other point, I'm just looking at some stock sheets. Conrad DeQuatros and John Riding always send me this stuff, my former kids. The Merrill Lynch high yield spread went up 288 basis points. So you're spot on there, too. I mean, it's just got recession written all over it. But in the remaining moments, Nancy, do you think, what are the recession odds in your judgment? I know it's a hard call to make, and I'm calling it the front end. I mean, look, the National Bureau of Economic Research, which is the arbiter of recessions and recoveries, they will say no recession call unless and until industrial production level falls, jobs actually fall, overall retail and wholesale sales fall, and real income falls. Now, we're not yet seeing that. My suspicion is production is falling, and we're going to start seeing that. But the rest of it is, so that's why you can't make a recession call yet in those terms. But, you know, how does that color your, I tell you what, it's an open-ended question. Hang on to it. I'll even try to remember what I just asked you. Let's take the break now, and we'll have more time on the other side, and you can tell us how to play in a recession scenario. We're talking to Nancy Tengler, Lafayette Tengler Investments, and Stephanie Pomboy, Macro Mavens. I'm Kudlow. We'll be right back.
This is the Larry Kudlow Show.